a very good starting point for us to continue our panel discussion at this stage. Let me say a few things about the second part of our session. The second part will be a panel discussion, and it will be on the basis of questions and answers. We have 4 panelists, 2 on stage, 2 online. I will say a few things about each one of them in one line, given the time constraint, and we'll change the sequence of the questions for some urgent matter that I will explain. We have the panel of 4. We have George Chouliarakis, who is Senior Fellow at Harvard Kennedy School of Government, and previously he was alternate Finance Minister of Greece from 2015 to 2019. We have Professor Dimitri Tsomocos, Professor of Finance at SAԻD Business School at Oxford University, and we have here on stage Evgeniou, the CEO of PwC Cyprus, and Maria Heracleous, who is Executive Director of Central Bank and member of the board of the bank. Okay, we'll start as follows. Okay, we start with Professor Tsomocos because he has a time constraint, so we are going to reverse some of the questions that were meant to be asked. And let me go to a bit to the Eurozone. Over the past 10 years, after the crisis began in 2010, we went through a sequence of restructurings and re-engineering of the European Union. We created a banking union, a fiscal framework. We're missing still a fiscal tool. The banking union is incomplete in some ways, but still functioning partially. So my question is, with the current crisis and all its consequences and repercussions, is this European framework and the banking union in particular fit for purpose?
Dear host, dear organizers, first of all, I would like to thank you for your invitation, and I want to apologize in advance for being unable to attend till the end the panel due to other prior engagement. And I'd also like to thank the Minister for his comments and to apologize that it was not Daron Acemoglu, not audible at least from where I am, so I cannot comment on that. I would like to be brief, and I would like to use, using my academic identity, some slides, which hopefully I would like to share. If you could possibly enable sharing, because I have some slides I would like to share. So the host needs to enable me. Okay, excellent. Thank you very much. So basically, the point I would like to make is very relevant to something that a professor of mine in the past, Rudy Dornbusch, had mentioned during the Mexican crisis, that the crisis, any crisis I may add, takes a much longer time coming than you think. And then it happens much faster than you would have thought. And now we can see that this crisis, that basically is a crisis that follows a global financial crisis, the first attempt was to use monetary policy in order to be able to deflect and prevent further adverse repercussions. As you can see from this slide, there is not too much room for monetary policy, and because central banks have thrown almost everything they've got at the crisis from the global financial crisis. Put differently, as Keynes has argued a long time ago, you cannot push a string anymore because you may end up in a liquidity trap. Moreover, this crisis, and that's very relevant with what's happening to the banking in the Eurozone, has signaled perhaps the end of globalization as you see the capital outflows, from the emerging markets, as compared to what happened to the crisis of 2008, what happened to the taper tantrum in May 17 to 13, and the China scare in 2015. If you see what's happening in the COVID-19, even though there is a partial a reversal of the capital outflow from emerging markets, that shows a substantial shift in the capital flows and the global capital movements. Now, the second leg that any economy can use, as very correctly was pointed out by the minister, to deflect the crisis, to prevent the crisis, is the fiscal policy. And we realize that in fiscal policy, the emerging economic divergence of North and Southern Europe, something that was mentioned already back in the 80s, is quite evident. We see that Germany and France have launched the biggest fiscal responses to the coronavirus crisis, and they have deferred fiscal support, deferred payments, loan guarantees, and so on and so forth. And you see that Germany and France are substantially more potent, their responses, as compared to the South. Please bear in mind that the South has already been hit tremendously by the Eurozone debt crisis 2012 to 2015. And this problem, the problem of the North and South divergence, is much more global, because if you see the difference of fiscal responses between North America, Australia, and Asia, again, we see the same type of pattern. Therefore, the North-South divergence is the main problem that permeates the entire European structure, institutional, banking, and social structure, and it can be very clearly be seen in the economic divergence between the North and the South from 1999 to 2018. And we realize that the entire Southern Europe, Italy, Spain, Portugal, Greece, to a great extent Malta and Cyprus, have not benefited in per capita GDP and purchasing power parity relative to the EU average, except one country, namely Germany, that has benefited by now substantially. Now, the other problem that exists in view of the COVID crisis, that we have an emerging problem in the African countries, where we see the capacity limitations that exist with respect to healthcare capacity.
For a while, we have 2 minutes remaining for this part of the. Okay.
Perfect. Then we see basically the responses of the financial regulation of the European Union and the Eurozone, whereby almost 140 billion euros of relief were offered amply. Now, my punchline will be, if we see the accumulating debt that exists. If you see the debt here, the non-financial private sector debt, the non-financial private sector debt as a percent of the GDP between December 19 and March 20, we see in the United States it increases, in the euro area it increases as well, as compared to the household debt ratio and the government sector, whereby more or less is stable. The point here is, if we see the non-financial corporate debt ratio, everywhere in the United States, in the euro area, in the United Kingdom, we have a substantial increase. Therefore, we have a banking problem, and the European banking union has to be extended and expanded with the European deposit insurance, and most probably it is a dire need to enter.
Okay, thank you so much, Professor. That's, I think, a good ending point.
One point.
Punchline, yes, of course.
One point that more evident and more necessary than ever to introduce asset management corporation, as has already been done in Ireland or Spain and Slovenia more recently. That's, I think, points in the direction of resolving this crisis. Thank you very much.
Thank you so much for your presentation. I think we are going to continue from the point at which Professor Tsomocos finished, the legacy of the crisis. We have a crisis that's very unique. It's very cumbersome. It's a combination of things, though. It's pre-crisis situations, it's post-crisis, and it's also the fact that we're transitioning into a new economy with a new tech infrastructure. So my question to Professor George Chouliarakis would be on the legacy issue. the accumulation of debt and the blowing up of central bank balance sheets, how do you think that's going to affect the global economy and how we can manage the coming fallout?
So thank you so much for having me in the forum. Can you hear me well?
Yes, you can. Can we? Yep.
Good.
Thank you.
So thank you so much for having me. I know we are short of time, so I will try to keep my answers as short as possible. Let me start by saying, first of all, that fiscal stimulus was the right way to respond to in the aftermath of the COVID-19 crisis. Without it, I think the ramifications of the crisis on the potential growth of the European and global economy would have been really disastrous. But the key question to ask is whether markets, capital markets in particular, have now changed the way they assess economic conditions and policy choices. If you go back to March this year, 2020, in the immediate aftermath of the crisis, capital markets responded by pulling out of many emerging markets and developing economies, flying back to the safe assets of the United States and Germany. But immediately after the policy choices of the Fed and the European Central Bank, they were again willing to lend and lend easily to many places across the world, including economies that usually wouldn't benefit from capital markets. Capital markets wouldn't really serve as buffers in cases of crisis for them. So is this a permanent change in the way markets assess the current and future economic conditions? I don't think so, and I think we have to keep in mind that economic conditions remain fragile. They can easily be reversed. And that's especially true for countries with a legacy of high debt-to-output ratios. Cyprus is one of them. Many Southern European economies are very much in the same position. So how do we go forward in these cases? I think there are five points to bear in mind. 6, if we want to consider also countries outside Europe. First of all, I think that fiscal policies should remain expansive in the near term. Fiscal policy stimulus should always be targeted, timely, and temporary, of course. Expansive for the next few months and quarters to the end of the pandemic, effectively till we come up with the vaccine. Point number 2 is that immediately after, fiscal policies should refocus on the conditions of economic recovery, move away from protection and focus on reallocation and recovery, main emphasis on wage subsidies and dealing with the legacy of private sector indebtedness. Point number 3, very quickly, emphasis should also be geared towards stability once again, and signals of policy of potential fiscal sustainability should be clear and sent out as early as possible in order to avoid sustainability and aggressive market reactions. Point number 4 is, I think, as far as Europe goes, the pandemic emergency purchasing program should remain available for many years to come. Point number 5, fiscal rule is a cornerstone, of course, of the European Monetary Union and should return from 2022 onwards. But the pace of consolidation, because consolidation will be needed, should take into account the risks that may cause the recovery. And finally, point number 6, especially for emerging markets and developing economies, key question is whether the IMF will have sufficient firepower to support simultaneously many countries, and that will be needed, and whether G20 step in and offer much longer grace periods in the debt repayment of those economies. So a very quick account of the state of play of fiscal policy going forward.
Thank you very much. At this point, I have to move a bit faster. So we'll leave it here regarding the after COVID and this problem created. I want to move to Evgenios and to Maria Heracleous on stage. And I wish to switch the focus a bit on the following. We're having a fallout from COVID. It's not just COVID. It's pre-existing trends and also the transition to a new economy, which is troubling businesses and policymakers. So from your point of view, Evgenios, as CEO of PwC and knowing CEOs of a wide range of companies and even countries, how do they assess the situation and how do they prepare for the COVID and the after-COVID situation?
Well, thank you very much. Let me say, yes, I agree that the trends that were with us pre-COVID have been accelerated because of the pandemic. And just very briefly touching on a few points already made, just to give a bit of color. I mean, PwC report indicates that 30% of jobs will either be eliminated or seriously disrupted over the next decade. At the same time, the CEOs in our global survey say that they cannot find the skills they need for their companies to prepare for the future. We cannot necessarily protect jobs, but we can protect the people, and we need to bridge the skills gap. So one of the issues that is very much on the agenda of CEOs is upskilling. Upskilling of their own workforce. Us as PwC, we have embarked on a very ambitious investment under the name New World, New Skills, to upskill our own people, to engage with communities, but also to help our clients. Now, beyond upskilling, which is absolutely necessary, we need a partnership with the state, and that's where the educational system comes into play. And increasingly, I hear from CEOs that our educational system, and I'm talking about Cyprus, is crying out for reform. We're a country that spends or invests substantially in education. We're one of the highest as a measure of GDP in spending in education, but we have to look at the outcomes, the quality and the skills that our children have for the future. Beyond that, the transition into a digital future is also accelerated by the pandemic, and we're seeing increasing interest by companies to invest in the new technologies. And again, this is an area where Cyprus is lagging behind the rest of Europe, and we have a lot of catch-up to do. I hope that the momentum created in the lockdown continues. And my last, the last thing I want to share has to do with sustainability. And many industry sectors of the economy, not only in Cyprus but across Europe, and CEOs are becoming more, let's say, interested in the issue of sustainability. And this is very much relevant here in Cyprus, and I'll just give two examples. In the tourist industry, we had a model that, broadly speaking, was competing on price, working with tour operators to bring good numbers of tourists to Cyprus. It is, in a crisis situation, the weaknesses of that model have been revealed. So we need something that is more sustainable. We have to have a tourist brand as a country. We have to have our own access to the tourist in many countries, and offer something that goes beyond sand and sea as a country. And the other aspect is property development, which is another key sector of the economy. And I hear more, let's say, reflections about moving into sustainable business models with affordable housing, housing for the elderly, given the demographic trends that we see in Cyprus, to create a more diversified business model for companies, and more broadly, a more diversified economy. Because the more diversified your business model is, the more diversified the economy is, the more sustainable it is, and the more you can adapt rapidly to changes. And I think the pandemic has brought to home a realization that was already there, but it brought it very loudly, that we have to be adaptable, we need to be agile, we need to be differentiated in order to succeed in a world that is uncertain.
All right. From that point onwards, let's touch a bit on the SMEs, the small companies in the country. SMEs has been and remains in the entire global world a source of employment, a source of innovation in many different ways, and they seem to be now on the defensive and facing the risk of belly up, of going bankrupt. Now, in this context, what's the future of the SMEs, and their demise will have consequences? How do you assess those consequences?
Well, I mean, the SMEs are the backbone of most national economies, and they are definitely the backbone of the Cyprus economy. And by European sort of definitions, most companies in Cyprus anyway are SMEs. I agree with you that they face particular challenges, and it has to do with certain issues that I have already mentioned. Maybe they were a bit late in upskilling their people. Maybe they were a bit late in investing in new technologies. Maybe they didn't really think through about having a sustainable and differentiated business model in the market, and there is a bit of catch-up. On top of that, you have heavy indebtedness in Cyprus. I mean, the private sector is still has high debts, and well, moving forward in terms of a positive note, I believe that again the pandemic has, for the first time perhaps, made a lot of companies here in Cyprus think about scenario planning, think about various sort of eventualities and what the consequences and how to deal with it, made them think again about their business plans and about sort of changing maybe those plans going forward and making them more sustainable. But fundamentally, and I'm talking about specifically about Cyprus, unless they fix their cash flows and unless they fix their balance sheets in terms of the level of debt, there are always going to be an issue there, especially with the uncertainties that are still around. And in that regard, I have to say that the measures taken by the government in the fiscal side, but also in the banking sector, have been very helpful. They have given sort of a breathing space. I believe that many companies have taken advantage of that breathing space to prepare. But perhaps, and my last word on this question is a reflection that maybe we should think again the sort of government guaranteed liquidity plan, either for potentially targeted to SMEs.
Thank you, Evgenios. Now, I want to go to Maria now, but before I get to banking and to Maria, I want to ask one more question for Chouliarakis. In terms of the Eurozone, the things that have been taking place this time around with this crisis have been unprecedented in terms of the action of the European Union and in the Eurozone. We've seen debt issuance, a common debt. We've seen grants as transfers. So the question is the following. Is that enough to save the day? And is it enough to save the euro in case the euro comes under attack in the future? That's a big question, but I want a small answer in 1 minute or and a half. We cannot hear.
Every fund has been a path-breaking movement in the development of European institutions for three main reasons. First of all, the new bond public goods, and therefore it allows member states to issue at a much lower borrowing cost than. Point number two is that it allows especially high-indebted economies to deal with the costs of economic recovery without obviously increasing their own national debt. And point number three is that it's a new tool, debt mutualization, that is very promising for the future. Europe has been for a very long time locked in a debate between strengthening economic resilience on one hand and increasing risk sharing on the other. I think this new tool is very important in putting emphasis on risk sharing, and hopefully we will see it develop further into the future. But also economic policy coordination, de facto coordination in many ways between the ECB and the European Commission this time around has been so much better than in 2008, 2010, and that helped really tremendously.
Thank you so much, Chouliarakis. Now, my last part of this discussion will be on Maria. I'll go to banking. Well, this time around, banks have been part of the solution and not part of the problem. but there are limitations to how much they can afford to be part of the solution. So the question is, how do you assess the state of banking locally and also in the European Union?
Thank you, Yanni, and thanks to the organizers for the invitation. Please note that the views I will express will be solely my own and not of the Central Bank of Cyprus or the Eurosystem. And let me first start with the global outlook for banks. Banks have entered COVID-19 crisis with significantly stronger capital and stronger liquidity than in the global financial crisis. This, of course, was very important because it allowed them to continue providing credit to the economy. Policies also were put in place whereby flexibility was provided in the regulatory framework, which further enabled the banks to provide credit. Of course, how resilient the banking sector will be depends on a couple of things. Depends on the duration of the pandemic, depends on the depth of the pandemic, and depends on also the willingness of the governments to keep supporting the private sector. Under a baseline scenario, most of the banks will be able to absorb losses. However, if the situation in 2020 is much worse than anticipated, and if the recovery in 2021 and 2022 is not as strong, then obviously some of the banks will face some challenges. Now let me move to Cyprus. Cypriot banks have so far weathered the pandemic pretty well, I would say. They have an abundance of liquidity. Capital is pretty stable. Encouragingly enough, we've seen some non-performing loan sales which have driven the NPL ratios down. However, the NPL problem still remains the biggest problem and the biggest challenge for the banking sector in Cyprus. And this is where our key policy priority should be the resolution of the NPL problem in a resolute manner. And what do I mean by that? I mean using all possible tools, using proper durable restructurings with the cooperative borrowers and being able to realize collateral with the non-cooperative borrowers. Of course, in this context, the stability and the effectiveness of foreclosure framework is very important. And this is very important irrespective of where the NPL is being resolved, whether it is in a bank, whether it is in a credit acquiring institution, whether it is transferred to an AMC to be resolved. So I would like to finish with that statement on how important that aspect is.
All right, I'll come back to it in my next question, the last one, I suppose, for this panel, as follows. Banks are facing problems in terms of profitability. It's very low, and it's low structurally speaking, so it's difficult to make capital when you don't have enough profit on your profit and loss. So under these conditions, what's your comment in terms of a trend to consolidation in European banking in particular, not in the States, but in Europe in particular, and in terms of a bad bank that's been rumored around in European corridors, even inside the ECB at some point, on these two aspects?
It's true that bank profitability is under pressure for many reasons: low interest rate, intense competition, digitalization, legacy issues. Therefore, a certain degree of bank consolidation could actually play an important role, and as such would be desirable. However, it is important to note that the role of the supervisor is not to assess whether consolidation efforts are beneficial as such. This is for the market to decide. The role of the supervisor is to see whether the resulting business combination complies with the prudential requirement and has all the necessary prudential risk management. That's on the consolidation. Now, about a bank. This has been discussed for a long time in Cyprus and at the European level. There are, of course, pros and cons to this idea. If you remove the NPLs from a bank, you allow the bank to focus on the banking, on new products, on the strategy. Also, this can act as a catalyst, as a further catalyst for further secondary NPL market enhancement. The other argument is that in a bad bank, there is more time for the resolution of the NPL because you don't have to face the capital requirements. However, there are certain challenges, and these challenges are mainly 3 or 4. It relates to the transfer price. It relates to the governance of the AMC. It relates to the specific loans that you can transfer. For example, in Cyprus, we have a lot of small loans backed by residential property, which are the most difficult to resolve both for social and political reasons. So looking at all this and taking all this in account, it is still not clear in my head on what the way forward is on the bad bank.
Thank you, Maria. Well, it's been a last session. It's been very tight with time. I must apologize. And at this point, I must wrap it up and thank everybody. I think we covered enough grounds. We don't have enough to finish it properly, but it's a good discussion. Thank you for Chouliarakis, Dimitri Tsomocos, previously the minister, and Daron Acemoglu, Maria Heracleous, and Evgenios. Thank you so much. And with this, we close.